Huge week in the markets coming up as the Fed is going to decide whether to cut rates or to keep them steady on May 7th. But more importantly, the S&P 500 is back at that 5,700 level that we discussed. We are also retesting the death cross, and we are at the high of Liberation Day, which was when the tariffs were announced and the second wave of that big drop. If we take a look at the SPY, we are also seeing volume drying up big time. There is no volume behind this push after that big 9% day on April 9th. And even though we saw a wave of breadth thrust indicators signifying that we will likely be positive 1 year later, we are also seeing a lot of positive momentum indicators in the short term. You could see this one here, up 6 days in a row. What that means for the S&P calendar year, which means at the end of 2025, we were positive every single time except for 2018, which ironically was the last time we had a tariff trade war. And all this comes on the heels of a renewed fight between the White House and the Fed, where now even Scott Bessent came out saying that bond yields show that it's time for the Fed to cut interest rates on May 7th. Now, I'm here to tell you, I don't think the Fed is going to do that. And just as late as last week, it seems that the Trump administration has their foot all the way down on the pedal when they talk to the media, not only in terms of maintaining the tariff policy, but also in terms of Americans expecting a recession. So in this video, I'm going to be breaking it down all for you, what to expect this week. And more importantly, we're going to be taking a look at the charts, as I think that 5,700 level that you see here, or 570 on the SPY, there is a wave of consolidation here, and there is just too much potential trouble here for me not to hedge at this point. Let's get right into it. So like I said, on May 7th, the Fed is going to meet. Now, it looks like the Fed has absolutely zero intention of cutting, not only based on what Jerome Powell and the other Fed members are saying, but even if you look at the Fed funds futures betting, 97% chance that the Fed actually maintains rates on May 7th and does not institute a cut. Let's take a look at last week's jobs numbers. You could see that the first wave of jobs data, the JOLTS job openings, came in much lower than expected. If you look at ADP non-farm employment change, much lower than expected. Those two things show a slowing jobs economy. Unemployment claims came in higher than expected, and it wasn't until the unemployment rate itself came out where the jobs data was quote unquote saved last week. 4.2% versus 4.2% expected. If that unemployment rate came in significantly higher than expected, then I think the Fed would likely cut on May 7th. But because that jobs data, that unemployment rate, which is the number one jobs data that the Fed looks at, came in at 4.2%, which was as expected, I think they're going to kick the can down the road and not cut. And for the first time in this whole ordeal, Scott Bessent is now joining the Trump train, saying that the Fed actually has to cut as bond yields show that it's time for the Fed to cut. What is he referring to here? Well, if we take a look at the 2-year yield versus the Fed funds rate, you could see that now the 2-year yield, which is in blue, is well below the Fed funds rate, which is in red. Funnily enough, this is what typically happens before recessions. You could see here in 2020 when the 2-year yield fell below the Fed funds rate. You could see here in 2008 that when the 2-year yield fell below the Fed funds rate. You could see this again in 2001 when the 2-year yield fell below the federal funds rate. And honestly, now I agree with Scott Bessent. I don't think that the Fed is going to cut, but I think that what the Fed tends to do is they usually wait until the last minute. And by the last minute, I mean until the employment rate, if the next one prints 4.5 or 4.6, then the Fed is going to cut. But at that point, the unemployment rate is a lagging indicator. So at that point, all of that momentum behind pushing unemployment to 4.5, 4.6% is already behind that push, and it is unstoppable. And one rate cut or 2 rate cuts after that is not going to stop that wave of slow jobs growth. So I actually finally agree with Scott Bessent here. The Fed has to cut rates if they want to achieve or try to achieve a soft landing here, but I don't think they will. And they will likely cite the tariff uncertainty and the uncertainty with tariffs regarding prices for American consumers as a concern there. Because remember, the Fed has 2 jobs. One is maximum employment, but 2 is price stability. And if they think that prices are going to go up because of tariffs, then they cannot cut. Now, remember what I told you in the last few videos, what I'm watching. I gave you a list of things that I'm watching in this economy and in this market to try to determine the moves that I'm going to make in the midterm. In the long term, I said that you have no excuse for not buying certain stocks at these valuations. I don't care what you think is going to happen in the future. you had to buy certain stocks at these valuations. We don't know what's going to happen in the future for certain, but we know for certain that this stock right here is at this valuation right here, at this price right here, and I cannot miss it. But anyway, neither here nor there. One of the things that I was looking at was White House messaging. Remember, I said the White House is telling you that they are trying to engineer a recession. They've been doing that all year. And the only time that they pull back is when bond yields get too scary. So just as of late last week, Trump comes out and says that this is Biden's stock market, not Trump's. Okay, we expect that type of rhetoric from him. But then he said, our country will boom, but we have to get rid of the Biden overhang. This will take a while. Has nothing to do with tariffs, only that he has left us with bad numbers, blah, blah, blah. Either way, we have to get rid of whatever Biden overhang or whatever you want to call it. He's basically saying this will take a while, so be patient. And even more directly and more surprisingly is what he told CNBC or NBC's Meet the Press. Let's hear it.
Wall Street have expressed concerns that the possibility of a recession is increasing. And I want to know what you think about that. Are you comfortable with the country potentially dipping into a recession for a period of time if you are able to achieve your long-term goals?
Well, you say some people on Wall Street say, well, I tell you something else. Some people on Wall Street say that we're going to have the greatest economy in history. Why don't you talk about them? Because some people on Wall Street say this is the greatest thing that ever happened.
Well, that's what I'm getting at. That's what I'm getting at, though. It's the same question.
Yeah, there are many people on Wall Street say this is going to be the greatest windfall ever happened.
And that's my question.
Remember
the
this.
long term. Yeah. Is it okay in the short term to have a recession?
This. Look, everything's okay. What we are, I said, this is a transition period. I think we're going to do fantastically.
The one thing I will give the Trump administration credit for is that they have given us a heads up for months and months that they are okay with a recession. Bessent has called it a reset. Trump is now calling it a reset. Bessent has called it a detox period. So they've been telling us this from jump. But as stock investors and traders, it makes it difficult to try to time things when all of these breadth thrust indicators are showing positive momentum that we typically see during the beginnings of bull markets. But we have also seen how complicated trade wars can make price action. So if you look at 2018, and I keep describing this personally as the weirdest year in stocks I've ever seen. I've seen worse years, but this was the weirdest year. Maybe the pandemic bottom was weird too, but they also printed a ton of money, so we knew that stimulus was coming. But in 2018, it looked like we were going to hit a bear market. Then we recovered about 2/3 of the way through and then came back for a double dip correction. But then throughout the summer, it was just a small stair climb, a smooth stair climb up past all-time highs before once again almost falling to a bear market. So I get these comments all the time that I get it. People want certainty. They want me to tell them this is a V-shaped recovery and we're going back to all-time highs. All panic is out the window. Or they want me to tell them, yes, we're absolutely going to tank from here, forgetting that sideways trading is also a real possibility, forgetting that 2018, one of the weirdest years in the stock market, something similar can happen as well. And that's why I keep hammering home the idea that you can only take what's in front of you. What's in front of you is the only certainty in this market, right? I can tell you with certain degrees of confidence what I think is going to happen. But at the end of the day, if they're trying to engineer a recession, there's only two things that you could do, in my opinion. Well, there's more than two things, but there are two things that you could do with regards to taking action. One is you buy up stocks at crazy valuations, regardless of what's ahead. And two, you protect yourself by hedging. Now, we're going to get into the charts, but with regards to what can happen with the economy, we already had one negative quarter of GDP. We need 2 quarters of negative GDP in order to call it a recession. Now, it is very possible that we get a second quarter of negative GDP. I shared this with you before, but there was this kind of timeline, this rough timeline put out by Apollo Research that shows if Trump does not take his foot off the gas pedal with regards to tariffs, then this is a likely scenario where we have the tariffs announced and then containers to the U.S. ports come to a stop. And if you hear the head of the Los Angeles Port Authority, you can already hear him saying that, yeah, we're getting much, much fewer shipments than we got a month ago. Those delays in shipping obviously cause delays in terms of truck delivery. and that then we will likely see empty shelves or less full shelves by the time the early summer hits. And by the time that summer hits, we will have a second quarter of GDP print. So all of this enthusiasm that we saw, which I'm thankful for because we bought stock, and I gave you guys the list, what I was buying, SPY, QQQ, Google, etc. I'm thankful for the gains that we've made in the market so far. But now that we're almost 2/3 of the way retraced up, aside from momentum and slightly positive news on the tariff pause front, so far the messaging from the White House, it seems like, one, they're okay with the recession, and two, they're okay with less products being on shelves. But that kind of slowdown in the economy will undoubtedly cause a negative quarter of GDP, a negative second quarter of GDP. And this is what I was saying last video, that I don't think this on again, off again tariff, I don't think that's going to get us back down to the 4,800 level that a lot of people are hoping for. Like, that's out the window, right? There's only so much that the market can consume of that. There's only so much of that content the market can consume before it gets exhausted, right? I've been around the markets a long time. I've seen how they work when it comes to sentiment. This on again, off again tariffs, like tariffs are on, no, they're off. They're back on, no, they're off. That is not going to get you down to that 4,800 level or below. What is something that actualizes the scenario for Americans. So if Americans do show up at Walmart and there are empty shelves, or they do show up and there are less product and people are now fighting over a limited supply, not only will that be now a real scenario on the ground for Americans, but then you're also going to be introducing stagflationary fears, right? Where because of limited supply, prices, and because of the tariffs, prices start going up, but there's a slowdown in the economy. That is the only type of thing, in my opinion, that will get the market back down to 4,800 or below. All right, but looking at the chart here, we're at a very pivotal moment. We're at that 5,700 level on the S&P 500, and I want you to see something. If we take a look at the gamma exposure, I want you to see where we have the most call and put gamma exposure and the most call and put open interest, exactly at 5,700 on SPX. This is where we have a huge wall here, both in terms of calls and puts. And this is the exact level that I was talking to you guys about for a couple of weeks now, where I said it's very common for, if I pull up the 50-day moving average as well, it's very common for after we create a death cross between the 50 and the 200 to go back and test that death cross. As a matter of fact, it has happened every single time. This is also an area of heavy consolidation, where we've had this consolidation from March to April. It's also at the golden pocket of the Fibonacci, about 2/3 of the way up from this drop. We're also at the 200-day moving average. And if we take a look at the difference between NQ on the left and S&P futures, otherwise named ES, on the right, you can see that we made a higher high in NQ futures and a lower high in ES futures. This is called bearish divergence. And from a sentiment standpoint, this was the day that tariffs were announced. And you could see this wave of bad news. And then we had a few pauses and some retractions from the Trump administration on some tariffs, right? And so now we are seeing a wave of optimism to match that decline of the tariff drop. So from a fair pricing standpoint, not talking about valuations here, but just with regards to sentiment, it seems like the bad sentiment was wiped out with good sentiment, and we are now at baseline. So in my opinion, hedging from here makes a lot of sense. Obviously, if you didn't buy any stocks, then what are you hedging? You're not hedging your cash. I'm only talking to those people who bought quite a few stocks on the dip, and now they're up quite a bit, and they might want to hedge because of the uncertainty that will come at this wall of worry here at around 5,700. So call prices are definitely inflated now because price has rallied so violently up. So calls are expensive, meaning you could sell covered calls as a strategy of hedging against your shares that you bought lower. I also outlined debit put spreads, which I showed you guys in the last video. I actually opened those on Thursday. Those are down a little bit because of Friday's price action, but I'm going to hold those through FOMC and see whether we see a decline from here in the short term, that I can pick up some dollars as insurance. Again, as of now, my portfolio is still very long. So when I talk about a hedge, I'm talking about a sliver of a percentage of your portfolio. opened up just as an insurance policy, basically. Would I personally short the market outright here without having any long positions? And the answer is no. Especially if you're not the type to have longed the market at, when we drop 20%. I know you're excited to short this market. I would suggest that picking up longs is way more valuable than trying to guess the top and short. But I would not short the market here naked, in my opinion, even though you can probably squeeze a day or two of retracement out of it. But the short-term momentum is undoubtedly bullish here. If I was going to short naked, I would have to wait until market structure was broken. So if we broke below this low and closed below it, then I would potentially look at a short on a retrace. So I would need some form of confirmation before actually taking a naked short if I didn't have any long stock here. Now, the momentum is bullish, and one of the things that can happen, like I said, it might be a while before there are any material effects on the ground from the tariffs. One thing that could happen is, yes, we could see a slow stair step towards that all-time high before a new wave of fear is introduced and the market slams again. One of the things that I'm eyeing here is the monthly chart. If you look at the monthly chart, you could see that we closed red for the month of April slightly, but we have this fair value gap here on the monthly, and you can see that we are pushing into it. If we close above 5,800 for the month of May, on the S&P 500, then yes, I think all-time highs are inevitable. But if we start digging into here in May, this is the area that I'm looking to see if we reject from, as long as we don't close above that 5850 level on the S&P 500. And speaking of May, should you sell in May and go away? If we take a look at the last 10 years, that's actually been a pretty horrible strategy. Now, there are a few stocks that I'm looking to pick up on a retracement here. So an example of this is Meta. I went over Meta's earnings. Meta's earnings were excellent, but we broke out of this long-term downtrend. Not only beat earnings, which everyone and their mom expected, but also one of the only companies that's actually making money from AI, including Microsoft. And I'm definitely looking to pick up Meta on retracements here. I don't care what happens in the future. I'm looking at its valuation right now. I picked up a little bit of it when it was below 500. But admittedly, I didn't get a full position on Meta. So I sent out an alert of at what price point I was looking to pick up Meta in this gap here between the 550 and 570 range. I have a $95 price target for Uber. This is a stock that we picked up in the low 60s. If you look at a stock like ASML's trend line since 2008, you could see that it is hanging on to this trend line perfectly. If we take a look at a lower time frame like the daily, you could see that it is likely due for a breakout. This is another stock that we picked up. ASML is a monopoly in its field of lithography for semiconductors. And there are a few stocks that I'm looking to pick up more of on retracements here. If you're familiar with the group, you know that we day trade futures and I swing trade options as well, but I day trade futures every single day. If you want to trade live with me, click the link in the description. If you just want access to all of my long-term alerts, including what stocks I'm picking up on retracements, there is a discounted membership for that as well, but you don't get to trade live with me every single day, which if that's what you're into, that's perfectly fine. I will be going live for FOMC. I think that if Powell sounds hawkish at this Fed meeting, that can put a temporary stop to this rally that we see here. I'd be very curious to see if they implement quantitative easing or start buying back treasuries, because apparently him and Besant are like this. If they do implement some sort of money printing, then I do think that it's almost a certainty that we continue rallying towards that all-time high. I don't make monetary policy. I have no idea of what's going to happen. I'm just almost 100% certain that they will not cut rates. I'll be going live covering that all for you as well. So subscribe to the channel, hit that notification bell, stay safe out there, traders. Peace.